Chapter 5 explains the external relationships of intermediaries. Business conduct is mainly related to client relationships. This chapter focuses on the internal business operations and practical regulatory provisions of intermediaries. In terms of business norms, there is a guide called Management, Supervision and Internal Control Guidelines for persons licensed by or registered with the Securities and Futures Commission, also known as the ICG, Internal Control Guidelines. This is a guide for intermediaries to manage their own companies, and this guide is issued by the SFC. This guideline covers 8 areas, namely management and supervision, segregation of duties and functions, personnel and training, information management, compliance, audit, operational controls, and risk management. We will explain each category one by one later. The SFC, Securities and Futures Commission, indicates that it will apply the guidelines with a practical attitude and does not expect small companies to have the same monitoring standards as large companies. So, does the ICG, Internal Control Guidelines, have legal effect? The guidelines, like codes, do not have the force of law. Violating these guidelines will never result in imprisonment. Of course, just like regulations, not following the guidelines may reflect adversely on the fitness and properness of the licensed or registered person. The SFC also made it clear that if your company is very small, it may not be able to fully comply with all the requirements in the internal control guidelines. Therefore, the SFC does not expect small companies to achieve the same level of internal control as large companies. However, small companies need to put effort into their monitoring systems to compensate for the reduced size and staff. In other words, they need to make up for the deficiencies in monitoring in other aspects. So, what makes it difficult for small companies to comply? First, there won't be a complicated system of segregation of functions because there are few people, making it challenging to divide the work too finely. Second, compliance and internal audit departments will also not be able to hire a large number of employees. With fewer people, it is difficult to hire a large workforce to carry out the tasks. What does internal control mean? Internal control refers to the comprehensive system implemented by intermediaries for the operation of their business. This system includes policies, procedures, checks, controls, and division of responsibilities. So what exactly is the goal of internal control? Why do we need this ICG, Internal Control Guidelines? The regulatory authorities hope that intermediaries 1. Can operate its business in an orderly and efficient manner. 2. Can safeguard the assets of its clients and its own. 3. Can maintain proper records and reliable financial and other information that it produces. 4. Can comply with all applicable laws and regulatory requirements. Therefore, the subsequent discussion is about the characteristics that regulatory authorities hope intermediaries can achieve in the 8 key areas of good business operation. Next, let's talk about management and supervision. The senior management should establish and maintain an effective management and organizational structure to ensure the operation of the business. What levels should the operation achieve? Sound, efficient, effective. These 3 levels need to be achieved. In this management and organizational structure, what roles does the senior management have? The senior management is responsible for the overall operation of the company, which means that if the company makes mistakes, the senior management is held accountable. The senior management is responsible for establishing and implementing internal control systems. This means that the monitoring system should be developed and decided upon by the senior management, determining how internal controls should be carried out, what procedures to follow, and which data should be monitored regularly, among other things. The senior management also has the responsibility to ensure the continuous effectiveness of the internal controls and the compliance of relevant systems by employees. What's the use of establishing a system if there are no requirements or supervision for employees to comply with? Therefore, the senior management needs to clearly define the reporting channels for employees and assign individuals responsible for supervision and reporting duties. When necessary, the senior management can delegate some of their workload and make necessary authorizations and divisions of work. However, it is important to ensure that the employees responsible for management and supervision have sufficient qualifications and experience, all right? What monitoring data should the senior management pay attention to? So, what should the senior management monitor? Firstly, the company's policies, their implementation, and the operation and financial position of the company. These are the most important and should be monitored regularly to identify any significant issues. Additionally, what are the qualitative risks of the company? Are there any weaknesses in current business operations? Once any major risks are identified, they should be promptly addressed. It is also important to monitor compliance with laws and regulations and identify any deviations from the business objectives. Are there any activities that are not in line with the company's established bylaws? These aspects should also be observed. Next, we are discussing a very, very important concept in exams, which is segregation of duties and functions. Remember, functions and duties should be clearly delineated. Each department should have a clear understanding of what tasks they should perform, and it is important not to assign one person multiple different tasks, especially those that may conflict with or be incompatible with each other. Why is this important? If one person is responsible for both financial reporting and auditing, they have the opportunity to manipulate financial data, misappropriate or manipulate company funds. Even if they are honest, there is a high chance of making mistakes when handling multiple tasks, which could lead to overlooking their own errors. So, if you do not differentiate functions and responsibilities, there is a risk of conflicts of interest or providing an opportunity for violations, resulting in losses for intermediaries and clients. This is very important, and it is a significant topic in exams to pay attention to the distinction between duties and functions. So how should functions be segregated? Remember, the following supervisory and logistical tasks should not be assigned to staff with line operational duties. What are included? Policymaking, supervisory, advisory, compliance, and internal audit functions. These tasks should not be entrusted to staff with line operational duties. The following functions should be segregated as much as possible to ensure their independence, including sales, dealing, accounting, and settlement. Sales, dealing, and frontline logistics, which are closely related to frontline business, should be separated as much as possible. To avoid conflicts of interest, research functions should be segregated from sales and dealing functions and be independent from the finance department. Internal audit and compliance should also be independently separated, and after separation, both departments should be able to report directly to the senior management. Remember, to prevent manipulation, misappropriation, and fraud, it is crucial to separate functions among different positions as much as possible. This is the ideal state that regulatory authorities hope to see. However, achieving this depends on the size of your company and the availability of resources in each department. Regarding personnel and training, what requirements does the ICG, Internal Control Guidelines, have? To ensure the operation of intermediaries, compliance with internal control policies and procedures, as well as adherence to all applicable laws and regulatory requirements, companies are required to establish and implement policies and procedures for recruitment and training. What does this include? Firstly, the company must hire fit and proper persons as employees. Additionally, the company should provide employees with up-to-date information on company policies, procedures, internal controls, and requirements regarding personal transactions. This ensures that their actions are in accordance with legal and regulatory requirements and adhere to the code of conduct. At the same time, companies should provide adequate training for employees to enable them to perform their duties effectively and meet the relevant CPT, continuing professional training requirements. In the aspect of information management, anyone acting as an intermediary must properly safeguard all data and documents related to company business operations. This is to ensure the data's integrity, confidentiality, availability, reliability, and completeness, okay? So what constitutes proper information management? First, regardless of whether the data is stored in physical or electronic form, employees managing the data must have the corresponding abilities, qualifications, and experience. Furthermore, the company's operational and information management system, including the electronic data processing system, must be well designed, secure, and operate efficiently with monitoring controls. There should be detailed documents explaining the design specifications and implementation program of this information management system, and regular inspections must be conducted. It is important to establish clear reporting requirements for data management to ensure that internal and external reports can be prepared in a timely manner and include necessary information. For example, within 1 week after the end of each month, provide business reports to the senior management of the company, including key business indicators such as sales figures and customer satisfaction. The most crucial point is to establish an effective record retention policy. It is necessary to clearly communicate with employees about which data to keep, how long to keep it, and how to keep the data. This ensures compliance with all applicable laws and regulatory requirements and facilitates access by auditors, lawyers, and regulatory authorities for review at any time. Intermediaries should establish policies and procedures to handle and safeguard electronic data to prevent errors, omissions, unauthorized deletions, modifications, or insertions, unauthorized access or manipulation of data processing systems and databases, unauthorized access or extraction of confidential data, such as customer data or data that can cause price fluctuations. These are all risks that need to be prevented. Why is data confidentiality important? It is not only for the benefit of the clients, but also for the protection of the interests of the intermediaries themselves, okay? Are there any real examples? For instance, Société Générale, a French bank, had a trader who fabricated data, resulting in significant losses for the bank. This highlights the importance of properly handling electronic data. Compliance is about ensuring intermediaries and their employees comply with laws, regulations, regulatory requirements, as well as internal policies and procedures, particularly in preventing corruption policies and codes of conduct. What should the senior management do? The first thing is to establish a compliance function. As we mentioned in the segregation of duties and functions, internal audit and monitoring should be independent and able to report directly to senior management. Therefore, when establishing the compliance function, senior management needs to ensure its independence from operational and business functions and its ability to report directly to senior management. Once a compliance department is established, what should the senior management do? They need to find someone responsible for monitoring and ensure that they possess the required skills, qualifications, and experience. The responsible staff should have access to all necessary records and documents to effectively carry out their duties without any limitations. Senior management should establish proper written procedures for handling complaints. If serious violations of laws, regulations, or regulatory requirements by intermediaries or any employees are discovered, they should report them immediately to the regulatory authorities. What should compliance staff do? Firstly, they should establish effective and comprehensive compliance procedures to ensure that intermediaries comply with all regulations at all times. These compliance procedures should include the following aspects. 1. Legal and regulatory requirements, including licensing, registration, and financial resources requirements. 2. Record keeping. 3. Business practices. 4. Prevention of money laundering. 5. Internal controls. 6. Client, proprietary, and staff dealings. Compliance staff should promptly report to senior management. What should they report? If the compliance staff discovers material breaches by employees of laws and their own regulations, or violations of the policies and procedures of the intermediary itself, they should report it to senior management to provide them with detailed information and understanding of the situation. In terms of auditing, the senior management of intermediaries should establish and operate an audit policy and review function which independently examines, evaluates, and reports on the adequacy, effectiveness, and efficiency of the intermediary's management, internal controls, and operations. Remember, auditing must be an independent function, separate from other departments. Like other functions, the personnel responsible for auditing must possess the necessary professional skills, expertise, and competence. The scope of authority for auditors, such as the work scope, objectives, methods, and reporting requirements, should be clearly defined. The auditing of intermediaries can be carried out by internal staff or external consultants. If external auditors are engaged, the roles, responsibilities, and working relationships between internal auditors and external auditors should be clearly defined in the agreement. During auditing and reviewing, auditors should adequately plan, control, and maintain records. They should promptly report the auditing findings, conclusions, and recommendations to senior management while following up on any identified deficiencies. In terms of operational controls, intermediaries should pay attention to the following when formulating daily operational policies, procedures, and monitoring measures. Whether information exchanges between the intermediary and its clients are adequate and in line with the code of conduct. Whether the dealing practices of intermediaries are complete and fair. Whether intermediaries can properly safeguard the assets of clients and themselves. Whether intermediaries maintain reliable and accurate records. Additionally, whether intermediaries and their staff can comply with relevant legal and regulatory requirements. To achieve the goal of monitoring, the control guidelines impose certain requirements on senior management. Firstly, for those acting as intermediaries, it is essential to clearly identify and obtain the identity, financial position, investment experience, and objectives of each client. Secondly, remember the previously mentioned discretionary accounts? Well, keep in mind that the terms of discretionary accounts should be clear, unambiguous, and ensure consistency between transactions and client data. Furthermore, it is crucial to minimize the potential for conflicts of interest. If it is not possible to avoid them, it is necessary to communicate and disclose them to clients, as discussed in the Code of Conduct. If the intermediary or its staff have a material interest in a transaction with a client, it should be disclosed to the client before the transaction takes place. When conducting transactions for clients, it is important to remember: client orders are handled in a fair and timely manner. Maintain complete audit trails, including properly documenting the entire process of trade execution and settlement. Senior management can establish proper safeguards to prevent misconduct by intermediaries or their staff. What are some of these measures? Establishing segregation measures to prevent the leakage of confidential information that may impact prices, thereby preventing staff from using such information for their own gain. For example, employees serving as corporate finance advisors may have access to first-hand information on potential acquisition activities, which could be exploited by other staff members for trading purposes in the market to gain profits. Additionally, measures should be taken to prevent insider dealing. At the same time, it is necessary to protect the assets of clients and intermediaries from losses due to theft, fraud, and other unauthorized or improper use. This can be achieved through clearly defining the authority of intermediaries and their staff, safeguarding assets in accordance with regulatory requirements, and establishing audit trails. Additionally, regular reconciliations of the intermediaries' records with external records and reports are carried out to identify any errors, omissions, or discrepancies. If any issues are found, immediate follow-up should be taken, and independent senior staff should review the previous verification process. This helps prevent unauthorized or improper activities. What should be considered when providing investment advice? If providing investment advice involves charging a fee and is not incidental, it falls under regulated activities. In such cases, a consultant agreement must be in place, specifying the applicable fees and penalty details, and it should be provided to the client in writing. Ensure that investment advice is based on the client's investment experience, objectives, and financial position after thorough analysis and is suitable for the client. Document the support of the provided investment advice clearly and provide a copy to the client. For example, if you recommend a client to buy HSBC stock, you must document the date, month, and year of introducing this recommendation to the client, explain the rationale behind the recommendation, and provide supporting evidence. These details must be in written form and a copy should be given to the client. Additionally, proper records should be maintained and retained for the extent of research conducted for investment advice and the documents underlying the recommendations provided to clients. When conducting transactions for clients, the process of handling orders should cover the recording and immediate time stamping of records of orders for clients and other orders, verifying the availability of funds or securities for the client to proceed with the transaction, checking for any special instructions from the client, such as authorization for operations or restrictions on the order placement. For example, if normally the client's orders are handled by employee A but today the client seeks assistance from employee B, it is necessary to determine if employee B has the authority to place orders, if the account opening documents specify who can place orders, and if there are any restrictions on employee B. These details need to be clarified. Identifying situations that may delay or withhold the execution of the client's orders. Establishing the procedure for transmitting orders to the trading floor. If necessary, assigning an independent senior staff member to handle the allocation of orders for clients. Remember, the main tasks of the back office are handling trade documents, which include transaction documents and external reports, such as those from the exchanges, counterparties, or executing dealers, for verification purposes. Conducting follow-up with clients. Recording trade errors and discrepancies to facilitate investigations or reviews by compliance and internal audit staff. How should intermediaries perform risk management? Remember, senior management has the responsibility to carry out effective risk management. Senior management should establish and maintain effective policies and procedures to manage risks. How can this be done? The first step is identification. Risks need to be identified first. The second step is quantification. Assess the magnitude of the risk and potential losses that may arise from it. The third step is control. Determine the appropriate methods to address the identified risks. Those who have participated in insurance examinations should have a relatively clear understanding of these concepts. What guidance does the control guidelines provide for risk management by intermediaries? First, intermediaries should establish a risk management function, preferably by appointing a dedicated, qualified, and experienced risk management officer. Second, after establishing the function, what's next? Senior management should define risk policies and establish procedures. These should address client default and changes in market conditions, ensuring that the risks borne by intermediaries themselves are maintained at an acceptable level. Additionally, if intermediaries engage in trading themselves, they should set trading and position limits, which should be reviewed daily after the end of the trading day. After setting up these policies, what's most important? It's reporting. Intermediaries should establish a comprehensive risk-focused review mechanism to continuously monitor risks and assess the effectiveness of their risk management policies. Risk management personnel should regularly report to senior management. Regarding the risk management monitoring guidelines, remember three things. First, appoint a dedicated and independent officer. Second, establish policies and procedures. Third, report to senior management. That's it. Since risk management is necessary, what are the common risks intermediaries usually face in their business? There are four main categories. Credit risk, for example, when a client cannot sell securities and does not have funds available to cover transaction fees, resulting in outstanding debts. If the client is unable to repay the debt and has no assets to execute, the intermediary will bear the loss. Similarly, when intermediaries fail to receive securities from counterparties during settlement, it can lead to losses. These situations related to client or counterparty contract non-performance fall under credit risk. How can intermediaries address credit risk? They can establish a credit rating system to assess the creditworthiness of clients or counterparties. Additionally, setting trading limits ensures that client limits are appropriate to mitigate risks. Market risk. Market risk refers to losses intermediaries face due to the fluctuation in the value of their own traded assets. For instance, if an intermediary holds a significant amount of stocks and the stock market suddenly declines, the value of their holdings will decrease. Similarly, if an intermediary has significant debt with floating interest rates linked to market rates, an increase in market interest rates will lead to higher interest payments. How can intermediaries control market risk? They can establish company policies for trading, clearly specifying permissible products and investment instruments, and setting trading limits to prevent excessive speculation. Additionally, employing risk-adjusted remuneration measures, such as tying trader compensation to the risk of their managed portfolios, can incentivize risk control. Liquidity risk. This refers to the risk of not being able to convert assets into cash within a short period to meet debt obligations or for trading purposes. For example, an investment company holding less common or low-volume stocks may face difficulty selling them quickly or at reasonable prices when suddenly in need of cash to fulfill client withdrawal requests. This is known as liquidity risk. How can intermediaries mitigate liquidity risk? First, invest in instruments that can be realized easily. Therefore, it is crucial to understand the liquidity of different assets before engaging in transactions. Second, establish relevant policies, such as tracking and analyzing liquidity indicators, example, cash flow ratios, short-term debt coverage ratios, conducting stress tests, simulating liquidity conditions under adverse economic scenarios, diversifying investments, and setting trading limits. Operational risk. Operational risk refers to risks and losses resulting from errors, omissions, inefficiencies, or negligence in day-to-day operations and compliance. How can intermediaries avoid or control operational risk? Unlike other risk management aspects, the guidelines suggest purchasing insurance. Conduct regular reviews of company operations to identify and address any issues promptly. One critical aspect is establishing effective business continuity plans, also known as emergency plans, to address specific risk events such as equipment failures or network attacks. Essentially, having a backup plan, Plan B, is crucial to prevent and mitigate operational risks. What is money laundering? Money laundering refers to the process of making illegally obtained funds appear legitimate through a series of operations. The funds obtained from illegal activities, also known as dirty money, are transformed into seemingly legitimate, clean money through this process, which is called money laundering. Why is money laundering necessary? For example, drug traffickers cannot directly deposit their drug proceeds into banks or use them to purchase large commodities. If their illegal activities are discovered by the government, they will be caught. Therefore, they need to find a method to make this money appear as if it were obtained legally. How is money laundering done? Money laundering typically involves three main stages: placement, layering, and integration. The first stage is placement. This involves placing the illegally obtained funds, dirty money, into the legitimate financial system. For example, a drug trafficking group may disperse large amounts of illegal cash across multiple banks, making small deposits each time to avoid arousing suspicion from the banks and regulatory authorities. Are there other methods of placement? Yes, they may also convert the illegal cash into other valuable assets such as gold bars, jewelry, or artworks. In recent years, virtual currencies like Bitcoin have also become popular means of money laundering due to their anonymity and cross-border mobility. The second stage is layering, also known as concealment. This stage aims to obscure the trail of the illicit funds through complex and frequent financial transactions, making it difficult to trace the origin of the illegal funds. For example, a drug trafficking group may transfer funds between different bank accounts in multiple countries or engage in buying and selling various financial products such as stocks, bonds, and other securities. They may also utilize offshore bank accounts and shell companies to hide the true source of the funds. Through these intricate layering transactions, the dirty money becomes increasingly similar to legitimate income, clean money. The third stage is integration. In this stage, money launderers seek to better integrate the clean money into the economy to avoid suspicion. They may use these funds for seemingly legitimate investments, such as buying properties or luxury cars, or investing in businesses while reporting false income. These methods allow the clean money to successfully flow back into the financial system, appearing as normal income from legitimate economic activities. For licensed institutions, particular attention should be paid to the layering stage. Money laundering and terrorist financing are both illegal activities that can involve various industries and sectors, including banking, securities, insurance, real estate, trade, and more. They pose significant threats to global security and economic stability. To combat money laundering and terrorist financing, many countries and international organizations have established comprehensive legal and regulatory frameworks. In Hong Kong, the issue of combating money laundering is primarily addressed through legislation. Regarding money laundering and terrorist financing, the relevant key legislation includes the AMLO, Anti-Money Laundering and Counter-Terrorist Financing Ordinance, the DTRPO, Drug Trafficking, Recovery of Proceeds, Ordinance, the OSCO, Organized and Serious Crimes Ordinance, the UNATMO, United Nations Anti-Terrorism Measures Ordinance, the UNSO, United Nations Sanctions Ordinance, and the WMD, CPS-O, Weapons of Mass Destruction, Control of Provision of Services, Ordinance. These laws apply to intermediaries and related persons in the industry. They have legal force, and violations can lead to imprisonment. Next, let's provide a brief introduction to the legislation related to combating money laundering. First, AMLO, the Anti-Money Laundering and Counter-Terrorist Financing Ordinance. The AMLO is an important regulation enacted specifically to combat money laundering and the financing of terrorist activities in Hong Kong. Violating the ordinance is a criminal offense. For general violations of the ordinance, the maximum penalty is a fine of 1 million Hong Kong dollars and imprisonment for up to 2 years. If there is deliberate deception of authorities or intermediaries, the maximum penalty can be 7 years of imprisonment and a fine of 1 million Hong Kong dollars. The AMLO requires intermediaries to conduct CDD, customer due diligence, risk assessments, and establish effective internal policies, procedures, and control measures to comply with regulatory requirements, report suspicious transactions, and thereby reduce money laundering risks. It also authorizes regulatory bodies such as SFC, Securities and Futures Commission, and HKMA, Hong Kong Monetary Authority, to regulate financial institutions and penalize non-compliant institutions. The DTRPO, Drug Trafficking, Recovery of Proceeds, Ordinance stipulates that anyone who deals with property that they know or believe to be the proceeds of drug trafficking is committing an offense. Here, the definition of dealing with illicit funds is provided. What constitutes dealing with illicit funds? First, being responsible for receiving illicit funds. Receiving or acquiring such illicit funds is already considered an act of money laundering. Second, concealing or disguising the illicit funds. This includes having accomplices transfer the illicit funds back and forth or finding a place to hide them. Third, disposing of or converting the funds. Using layered transactions or engaging in unreasonable transactions to convert and handle the illicit funds. Fourth, moving illicit funds in or out of Hong Kong. Fifth, using the proceeds of illicit funds as collateral or for lending purposes to launder the funds. All of these actions are considered dealing with illicit funds and engaging in money laundering activities. What is the OSCO, Organized and Serious Crimes Ordinance, about? In essence, this ordinance empowers the police to require individuals to provide information related to the investigation of organized crimes and conduct searches. The main objective of this ordinance is to combat various forms of organized crime, including drug trafficking, fraud, money laundering, terrorism, and more. What does the UNATMO, United Nations Anti-Terrorism Measures, Ordinance stipulate? Its main goal is to prevent any funding supporting terrorist activities, specifying providing financial support to terrorists or related personnel, as well as raising funds or seeking financial services for them, are criminal offenses. At the same time, the UNATMO also allows the freezing or confiscation of the assets of terrorists. Moreover, it requires anyone who knows or suspects that property belongs to a terrorist to have the obligation to report to authorized personnel. Failing to report despite knowing is also an offense. The WMD, CPS, Weapons of Mass Destruction, Control of Provision of Services, Ordinance, the name sounds quite scary, right? And what does it have to do with intermediaries? The WMD, CPS, primarily targets weapons that can cause mass destruction, clearly stipulating that no services related to the proliferation of such weapons can be provided, including financial support. Similarly, those who break the law will be regarded as criminals, potentially facing unlimited fines and up to a maximum of 7 years in prison. After talking about so many regulations, intermediaries might be overwhelmed. How can they handle matters related to money laundering? The SFC, Securities and Futures Commission, has issued the GAML Guideline on Anti-Money Laundering and Counterfinancing of Terrorism for licensed corporations, according to the powers conferred by the AMLO, the Anti-Money Laundering and Counter-Terrorist Financing Ordinance, to help licensed corporations comply with anti-money laundering regulatory requirements. You might ask, does this guideline apply to registered institutions? The answer is no. As mentioned, it only applies to licensed corporations. Since it's called a guideline, it is advisory in nature, which does not have the force of law. However, if the guidelines are breached, it may reflect adversely on the fitness and properness of the license holder, and there's a possibility of disciplinary sanctions, including fines. Do you still remember what an associated entity of an intermediary refers to? It refers to a company that has a controlling relationship with the intermediary and holds the client assets of the intermediary in Hong Kong. Concerning money laundering, the associated entities of licensees must comply with the Prevention of Money Laundering and Terrorist Financing Guideline issued by the Securities and Futures Commission for associated entities. As for registered institutions and their associated entities, are they not regulated? No, they are required to comply with the guidelines of the HKMA, Hong Kong Monetary Authority. As we've mentioned before, money laundering involves 3 major stages: placement, layering, and integration. In reality, licensed corporations usually don't accept cash, so there's generally no issue with the placement stage. However, criminals are very crafty, and most issues occur at the layering stage. How do they do it? For instance, they use the money in a series of securities transactions, taking advantage of the liquidity of the securities futures market, establishing complex audit trails, and attempting to confuse law enforcement agencies. As a licensed corporation, you certainly don't want to get involved in the risks of money laundering activities. So, what should you do? You can adopt a risk-based approach. What is a risk-based approach? Licensed corporations should identify, manage, and mitigate their exposure to money laundering risks. Specifically, they need to perform 2 types of risk assessments. 1. Institutional risk assessment. Look at the nature, size, and complexity of the licensed corporation's own business to identify its risks. Then apply suitable policies, procedures, and controls to manage these risks. This risk assessment should be updated at least once every 2 years. 2. Customer risk assessment. Conduct an assessment based on the risk level associated with customer or proposed business relationship. The 2 types of assessments we talked about earlier don't have a clear set of risk indicators. Usually, we need to consider 4 main risk factors: country risk, customer risk, product/service/transaction risk, and delivery/distribution channel risk. 1. Country risk. Certain countries are particularly prone to money laundering activities, such as Colombia, Afghanistan, and Laos, which are areas with severe drug trafficking, making them particularly prone to money laundering. 2. Customer risk. Some customers have unique backgrounds and situations, such as political and military figures from various countries or senior executives of multinational organizations. In addition, the customer's ownership structure is very complex, and it may involve different companies and different accounts. Also, some customers' business nature may be sensitive, such as defense, military industry, pharmaceutical, Entertainment, these are more sensitive industries. 3. Product/service/transaction risk. People who launder money usually act anonymously and won't let you know who they really are. Financial instrument transactions equivalent to cash and cross-border service transactions are methods they frequently use. 4. Delivery/distribution channel risk. People who launder money often use non-face-to-face account opening methods, such as online mail, telephone sales channels, etc., to interact with intermediaries. At the same time, in terms of payment methods, cash-intensive businesses are the most dangerous. So, whether it's dealing with customers from sensitive countries or industries, or providing products and services, conducting transactions, and delivery methods, all involve risks of money laundering. Intermediaries should be particularly careful about these risk factors when conducting risk assessments. Do you remember what we mentioned before about a risk-based approach? The idea is not to do too much, but also not to do nothing. Therefore, the anti-money laundering measures adopted by licensed corporations should be commensurate with their risks. In this way, the resources invested by the licensed corporation can be matched with the actual risks, thus more effectively allocating resources. So how to do this specifically? The first step is to establish a system for combating money laundering and terrorist financing. The second step is to manage the customer's money laundering risks. The third step is to monitor transactions. The fourth step is to report suspicious transactions. We will introduce each of these in detail in the following. First step, how should licensed corporations establish a system for combating money laundering and terrorist financing? The most important thing for intermediaries to deal with money laundering issues is what? It's about setting up a system first. The system to combat money laundering and terrorist financing is a system set up by licensed corporations to manage and reduce money laundering risks. With the system, it's easier to identify and control money laundering risks. First, as long as it complies with legal provisions, licensed corporations can enhance or simplify the system according to the risks identified. Secondly, this system also needs to include compliance management arrangements, independent audit functions for assessing system implementation, employee selection procedures, and ongoing employee training programs. Moreover, appropriate positions need to be established for system implementation. In Chapter 5, we discussed the core function supervisory system of the SFC, Securities and Futures Commission, where we mentioned that one of the 8 core functions of the senior management is to combat money laundering and terrorist financing. Intermediaries need to appoint at least one compliance officer to be responsible for this core function. The compliance officer takes on this role, being fully responsible for the formulation, supervision, and implementation of the anti-money laundering system of the licensed corporation. Licensed corporations also need to appoint a MLRO, Money Laundering Reporting Officer, who acts as a central reference point for employees to report suspicious transactions. That is to say, he is the person to go to for all suspicious transactions related to money laundering within the company. At the same time, the MLRO is also the main contact person with the JFIU, Joint Financial Intelligence Unit, and the law enforcement agencies, as suspicious transactions will eventually be reported to the JFIU. Finally, guidelines need to be provided to employees to help them gain awareness and vigilance so that they can identify potential money laundering and terrorist financing activities or have suspicions during the process of providing services to clients. Second step, how to manage customer money laundering risk. 1. Customer identification and risk profiling. The money laundering risk of licensed corporations usually comes from the customers, so it's necessary to determine if they are suspicious persons. So how to identify the customer's identity and risk situation? Firstly, verify the customer's identity. According to the type of customer, if the customer is an individual, require them to provide identification documents, such as a passport or address proof. If the customer is a legal person, such as an incorporated company, a foundation, partnership, association, etc., or trust or other similar legal arrangement, it may be more complex. For example, a company would need a company registration certificate, record on the company's registry, etc. In any case, the documents should come from reliable, independent institutions, like government agencies. Secondly, a risk-based approach to assessing risks means that when customer due diligence should be subject to enhanced measures for higher-risk customers, that is, you should keep a close eye on them. Using more stringent measures may be simplified for lower-risk customers, that is, you can use simplified measures. 2. Ongoing monitoring of customers. Is customer due diligence enough? It's hard to predict a person's behavior. People change their minds, customers are the same. Therefore, after the licensed corporation has opened an account for the customer, it needs to continue monitoring the activities in the customer's account to see if there are any abnormal or suspicious activities. How to observe it? Pay attention to whether the customer's activities correspond with the intermediary's understanding of them. What kind of understanding? Their business, risk profile, and source of funds. In the process of ongoing monitoring, the same risk-based approach should be used. Increase the monitoring of high-risk customers and decrease the monitoring of low-risk customers. Record keeping and retention. Whether it's customer due diligence or continuous monitoring, the licensed corporation also needs to pay special attention to establishing audit trails for changes in customer assets. What exactly are these trails? For example, who is the customer? Where is the money coming from? What transactions have been made? Where did the money end up in the end? All of these need to be recorded and stored well. Why? Because these clues are crucial for subsequent investigations and tracking of money laundering activities. So, what records should a licensed corporation keep? 1. Documents used to identify the customer's identity, including any beneficial owners, persons acting on behalf of the customer, and other relevant parties. We talked about this when we introduced Know Your Client. 2. The purpose of the business relationship with the customer. 3. Forms concerning the customer's account. 4. Other documents and records obtained throughout the CDD, customer due diligence, and ongoing monitoring process. 5. The results of any analysis undertaken. For example, if the licensed corporation discovers that the customer has a large transaction that does not comply with the customer's normal transaction pattern, or the transaction is too complex in structure and can't be understood, the licensed corporation may need to conduct more in-depth analysis to confirm the background and purpose of the transaction. This kind of analysis conclusion also needs to be stored. 6. A record of the data and information obtained in relation to each transaction to facilitate the reconstruction of each transaction later. So, how long should these documents be stored? For documents about the customer, they should be kept for at least 5 years after the end of the business relationship with the customer. What if you have an ongoing business relationship with the customer? Should you still keep it? Of course. As for transaction documents, they should be kept for at least 5 years from the date the transaction is completed, to meet the requirements of this money laundering guideline, all right? Step 3. How to monitor transactions. To effectively monitor transactions and prevent money laundering activities, the licensed corporation also needs to have adequate systems and procedures, including making special reports for large transactions, providing timely and adequate data to relevant personnel so they can identify, analyze, and effectively monitor customer transactions, such as checking if transactions have obvious economic or legal purposes, facilitating the observation and tracking of possible abnormal activities. The design of this system should be risk-based and commensurate with the nature, size, and complexity of the company's business, as well as the types of products and services offered by the company. What are some examples of suspicious transactions? Here are some examples of suspicious transactions, meaning that the customer is more likely to be money laundering. If they do these things, does it mean they are definitely laundering money? Not necessarily, but the likelihood is higher, understand? Such as 1. Situations related to the customer. The customer requests investment services, but the source of funds is unknown. Or the customer's sources of funds are many, but they do not match the financial background of the customer's income. Or, the same beneficial owner opens many accounts at intermediaries. Why does one person need so many accounts? Why open 10 accounts in one company? This could be suspicious. 2. Situations related to transactions. Their buying and selling activities are unusual, such as unnecessary buying and selling, or transactions with no obvious purpose. Furthermore, they frequently make small cash transactions and then sell them all at once, with the proceeds of the sale going to a third party. It's not normal to use cash, and the proceeds from the sale go to a third party, not to themselves. Why make it so complicated? We need to pay attention to these illogical transactions. 3. Selected indicators of market manipulation and insider dealing. For example, first buy a large amount of a specific stock, causing the price of the stock to rise, and then when the price rises to a certain level, sell in large quantities, or abnormal trading behavior that appears before significant news is disclosed, etc. 4. Situations related to the deposit of securities. The customer likes to frequently buy the same stock and then immediately sell it, and this behavior seems to lack a reasonable business reason. 5. Situations related to settlement and movement of funds and securities. For example, using cash or cash equivalent financial instruments or making large transactions anonymously, these all need to be careful, okay? If the customer stores a large amount of money in the account of the licensed corporation, but this money is not used for investment or buying and selling, why do they want to store the money here? Usually, they want to avoid stricter bank supervision, so they store it at the licensed corporation. Another important clue for money laundering is frequent financial exchanges with third parties in an account. Whether the customer frequently transfers funds to the third party's account or frequently receives funds paid by the third party by check, and the identity of this third party is not clear and difficult to verify, it is more suspicious. 6. Situations related to employees. If an employee is laundering money, what are some characteristics? For example, the employee's lifestyle will change, suddenly spending a lot or not wanting to take a vacation, but without a reasonable reason. The employee's sales performance is unusual and does not match the expected increase. Furthermore, employees and their associates provide forwarding addresses for customers, helping the customer receive letters, bank statements, etc., possibly hiding the customer's actual address. Why is an employee not wanting to take a vacation a suspicious situation? They may be trying to cover up some improper or illegal behaviors, possibly fearing that colleagues will discover these behaviors during their vacation, so they don't want to take a vacation. These are situations that are more likely to involve money laundering. If the continuous legal entity has similar suspicious situations, further inquiries are needed, understand? Earlier we mentioned the example of a third party in suspicious transactions. Let's add a bit more now. In the process of money laundering, especially in the placement and layering stages, third parties are most likely used to hide actual economic activities or to cover up the real source of funds or their destinations. They may be involved in complex, intricately designed transaction structures, making it very difficult to trace the flow of funds and the ultimate beneficiaries. For example, Chan Ho Nam made a lot of illegal money through illicit activities. In order to launder the money, he found his friend Mountain Chicken and deposited a large amount of cash into Mountain Chicken's securities account, then conducted a large number of transactions through Mountain Chicken's account, buying and selling various kinds of securities. After a while, this money seems to have come from normal securities trading profits. At this point, Chan Ho Nam asked Mountain Chicken to withdraw the money and transfer it to him. In this way, the original illicit money has been laundered, appearing as if it came from legitimate securities transactions. Therefore, reviewing and verifying the participation of the third party and their role in transactions is crucial in preventing money laundering and terrorist financing. To reduce the risk, additional actions must be taken by licensed corporations when receiving instructions after establishing a business relationship with a person acting on behalf of a customer or opening an account. What additional actions? First, the identity of the person purporting to act on behalf of the customer should be verified in the same way as the client's identity is confirmed. At the same time, his authorization to act must also be confirmed. A risk-based approach should be taken, with more stringent scrutiny measures taken against high-risk third parties. Finally, when a client makes payments or receives investment income through a third party, it should be approved by senior management. We have previously introduced that during the layering stage of money laundering, criminals may frequently transfer between different bank accounts in multiple countries or buy and sell various financial products, such as stocks, bonds, and other securities. They may make good use of offshore bank accounts and shell companies to hide the real source of funds. This involves cross-border correspondent relationships. There is a question: can licensed corporations provide services to financial institutions outside Hong Kong? Yes, they can. These financial institutions located outside Hong Kong are called respondent institutions. Licensed corporations can provide them with services such as dealing in securities, dealing in futures contracts, or leveraged foreign exchange trading. However, licensed corporations usually can only obtain limited information about the customers and transactions of the respondent institutions, and insufficient information will bring about the risk of money laundering. So, what should licensed corporations do? Similarly, licensed corporations need to take additional steps to reduce the risk of money laundering. What extra steps need to be taken? This includes: monitor and review on a regular basis and fulfill customer due diligence for the respondent institution and customers of the respondent institution that have direct access to the account. If the licensed corporation and the overseas financial institution are related, that is, they belong to the same group, and the group has an anti-money laundering and counter-terrorist financing program at the group level, the licensed corporation can adopt a streamlined approach. However, it is a prerequisite that after approval and evaluation by the senior management of the licensed corporation, this program can satisfy the requirements of the SFC, Securities and Futures Commission, be able to adequately mitigate higher risk factors, and effectively implement supervision. But remember, some financial institutions, even if they belong to the same group as the licensed corporation cannot establish a cross-border agency relationship with them. Which type of institutions? Those without a physical presence in Hong Kong, meaning no actual physical office location or operation location, are what we call shell companies or offshore companies, and are not subject to effective supervision by the entire group. These types of financial institutions, the licensed corporation cannot establish a cross-border agency relationship with them. Step 4. How to report suspicious transactions. We've introduced various situations and activities related to money laundering earlier, so who should suspicious transactions be reported to, and how? The JFIU, Joint Financial Intelligence Unit, has suggested a disclosure procedure. First, who has the responsibility to report? Anyone who has suspicions about a person, transaction, or property has the responsibility to make a report. To whom should the content be reported? It should be reported to the JFIU. What is the disclosure procedure? Once a suspicious situation possibly involving money laundering is identified, the first thing to consider is whether a disclosure needs to be made. How to consider this? This might include having an urgent discussion with senior management, appropriately questioning the client, reviewing all the information about this client. After careful consideration, if there are still concerns and the decision to report is made, the JFIU should be immediately notified. What needs to be done after the report? Licensed corporations or related entities must preserve complete records of the disclosures made to the JFIU, including details such as the reporting date and the identity information of the reporter. The JFIU will confirm receipt of the suspicious transaction report. If the JFIU does not deem it necessary to take immediate action, the licensed corporation may continue to operate the relevant account. However, remember that once a licensed corporation or related person makes a disclosure to the JFIU, they cannot issue a notice or warning to the client. As we mentioned earlier, the senior management of a licensed corporation must bear the ultimate responsibility for the corporation's compliance with AML, anti-money laundering, and CFT, counter-terrorist financing regulations. Therefore, a system to combat money laundering/terrorist financing must be established. This system should include compliance management arrangements, system effectiveness evaluation, employee selection processes, and ongoing employee training programs. So, how does a licensed corporation evaluate the effectiveness of the system and confirm whether the corporation is in compliance? The SFC, Securities and Futures Commission, has an AML/CFT self-assessment checklist. Licensed corporations and their affiliated entities can use this checklist for regular checks and self-assessment. This will review the effectiveness of the anti-money laundering system and review and supervise the corporation's compliance status. How often should it be done? It can be decided based on the specific circumstances and risk level of the company. To combat money laundering, one needs to know how to deal with money laundering activities. Therefore, licensed corporations should regularly provide appropriate anti-money laundering training to their employees, educating them about money laundering laws, rules, and the company's policies and systems. The training content should match the roles taken by the employees so that they can effectively implement the company's anti-money laundering system. If there are new employees, they should receive training as soon as possible. Employees also need to pay attention to 1. The obligations of both the licensed corporation and the individual. If they fail to comply with the customer due diligence and record-keeping requirements, they might need to bear the consequences. 2. The policies and procedures of the licensed corporation relating to anti-money laundering and how to identify and report suspicious transactions. 3. New and emerging ways that money laundering might be engaged in. For instance, Bitcoin and other cryptocurrencies are now popular. Due to their anonymity and the convenience of global transactions, they have become a means of money laundering. Virtual currencies on online gaming platforms can also be used for money laundering. In addition, some online marketplace platforms, such as e-commerce websites or online auction sites, may also be used as money laundering tools. If you're not aware of these, it's hard to prevent. 4. Whether there are any clients from countries listed in the United Nations sanctions list. These could include political or military personnel from certain countries or individuals involved in business sectors that are more sensitive and may involve defense, military industry, and other sensitive industries. So, license holders need to be particularly careful when such clients come to open accounts. Electronic trading refers to conducting transactions via computers. So, when conducting such transactions, are there any particular things to pay attention to? First is the product of the transaction. Electronic trading is only for securities and futures contracts traded on the exchange. Can securities not traded on the exchange be electronically traded? No. How about over-the-counter derivatives? No. Absolutely not. Next is the activity of the transaction. What does it include? 1. Internet trading, i.e., receiving clients' order instructions via the Internet. 2. Direct market access, DMA, i.e., sending clients instructions directly to the counter system of the exchange for execution without going through a broker. 3. Algorithmic trading, i.e., a computer executing trading activities according to preset rules, such as automatic buying and selling rules. Let's take an example to make it clearer. Easy Securities has a client called Stephen Chow, who had nothing to do this morning, so he placed an order through Easy Securities apps. The broker at Easy Securities helped him buy some 10-cent stocks, which is called Internet trading. Stephen Chow can also use a special service from Easy Securities. On Easy's trading platform, he can send buying and selling instructions directly to the exchange in real time, just like in a stock exchange hall, without going through a broker. This is direct market access. Stephen Chow is actually very busy and doesn't have time to keep an eye on the monitor for stock market fluctuations. Therefore, in his account at Easy Securities, he set up some automatic buying and selling rules to manage his investments. For example, if the price of 10-cent stock drops to 300, the system will automatically buy a certain amount of 10-cent stocks. On the other hand, if the price of 10-cent stock rises to 360, it will automatically sell. This kind of transactions automatically executed by computer programs is called algorithmic trading. Electronic trading relies on electronic systems. Any technical failures or operational errors, such as network interruptions, computer viruses, hacker attacks, or operational errors, could potentially lead to transaction failures or delays, and even risks of data leakage or transaction tampering. Of course, the SFC, Securities and Futures Commission, won't stand by and watch, so it has set up some regulations for electronic trading in the Code of Conduct. So, what does it include? Firstly, who needs to be responsible for the electronic trading system? Intermediaries are responsible for the electronic systems used by their clients. They need to ensure that the processes of trading and settlement run smoothly. At the same time, the way intermediaries manage their systems must comply with regulatory requirements. They must develop policies, procedures, and monitoring measures to supervise electronic trading. So, how should intermediaries manage and supervise electronic trading systems? First, what is the most important thing? Of course, it is to establish written internal policies and procedures for the electronic trading system. Second, appoint someone to be specifically responsible for this matter. Thirdly, what's that? It's about providing adequate resources for the system, including what? Staff, equipment, money, and all three are indispensable. Without these, the system cannot operate effectively. If the electronic trading system is unreliable, it would prevent investors from placing orders in real time and miss significant investment opportunities. If the security of the electronic trading system is not adequate, such as being attacked by hackers or leaked, it could lead to substantial financial losses. The trading system needs to be able to handle a large number of trading requests. If the capacity is not enough, it will become very slow and could even crash the system. Therefore, intermediaries also need to ensure the integrity of the electronic trading system, ensuring that it is safe, reliable, and has sufficient capacity. So, what measures need to be taken to effectively ensure the integrity of the electronic trading system? Firstly, there must be control measures to stop the system from generating abnormal transactions. For example, due to a malicious attack, the system suddenly starts to generate a large number of buy orders for a specific stock without limits, and sends these orders to the market at the same time. Intermediaries need to set up effective monitoring measures to detect such abnormal transaction behaviors, and can automatically block or revoke relevant instructions. Secondly, the system must undergo repeated testing before being put into use, and be regularly checked after it has been put into use. In case of any significant interruption, it must be immediately reported to the SFC, Securities and Futures Commission. Thirdly, set up security monitoring measures, such as authenticating access, ensuring data confidentiality, and preventing intrusion. Fourth, monitor the capacity of the electronic trading system, regularly conduct stress tests on the system to see how much trade volume it can handle at the same time at its peak, and record the results of the tests. What's the most important thing? It is a backup plan and contingency arrangements, that is, having a plan B. Sufficient alternative means must be in place, ensuring there is spare capacity to cope with sudden situations. If the system has issues and can't process orders, a backup plan can be adopted, such as placing orders over the phone. Why do we need a plan B? It can reduce operational risks and ensure that the client's trades won't be affected. So, do we need to keep the records of the electronic trading system? It's not about the customer's transaction instructions in the system, but the records of the system itself, i.e., the records of its development and usage scenarios. Remember, the design and development records of the electronic trading system used by the intermediary, along with risk management and monitoring measures, these documents need to be well preserved. Even if you stop using the system, they should be kept for at least 2 years. But while it's in use, needless to say, it should always be kept. As for the system's audit logs on the activities, or incident reports on material system delays or failures of the system, they should also be kept for at least 2 years. To control risk, the electronic trading system of the intermediary, when handling customer transaction instructions, needs to ensure that all customer transaction instructions can be correctly and accurately transmitted to the corresponding processing systems. Also, the electronic trading system needs to have an automatic transaction checking function. What kind of function? Firstly, pre-trade controls, including 1. Preset trade limit. It can automatically check each customer's trades to see if they have the permission to make this trade and what their credit limit is. For example, if a customer wants to buy stocks, but they don't have enough money, the system may pop up a message. Hey, you don't have enough money. Moreover, it can automatically check the company's proprietary trading restrictions. That is, what level of the company's own trading would be considered risky. The system will not allow such operations. 2. Detection of erroneous orders and alerts. Issue alerts for potentially erroneous transaction orders and do not allow the entry of erroneous transaction orders. For example, a customer wants to buy 100 shares of Apple stock, but when entering the order, they accidentally input 10,000 in the quantity field. The system will immediately issue a warning, letting the client know that the quantity is incorrect. Additionally, post-trade monitoring. Analyzing executed trades, identifying any potential market manipulative or abusive order instructions. In terms of Internet trading, to help licensed corporations conduct regular self-checks and improvements on the electronic system, and to ensure compliance with relevant electronic trading regulations, the SFC, Securities and Futures Commission, has developed a self-assessment checklist. The self-assessment covers management oversight, user access controls, the design of the network infrastructure, application controls and processing integrity, system implementation and upgrades/modification, backup and contingency planning, monitoring, vendor management and testing of application vulnerability. While we have clear requirements for electronic trading systems, computers are, after all, inanimate. It's people who bring life. If the user doesn't know how to use it, then no matter how well the electronic trading system is designed, it's useless. So, before and after opening a DMA, direct market access service for a client, the intermediary must evaluate the client. What do we evaluate? 1. Whether the client is proficient and competent in using the system for the DMA services. 2. Whether the client understands and complies with applicable regulatory requirements. 3. Whether the client is able to monitor the orders entered through the DMA services. Why do we have so many requirements? Because DMA services are usually more complex, faster, and involve relatively higher risks. For instance, if market conditions suddenly change, or the client makes a mistake in operation, the client's orders can be executed in a matter of seconds, possibly without enough time to cancel or modify the orders. Therefore, it requires the client to have certain professional knowledge and skills, and is generally more suitable for institutional investors and large traders. For individual investors with relatively limited resources or knowledge, using a broker to trade may provide more support and guidance. Next, we're talking about algorithmic trading systems. If you, as an intermediary, are using these algorithmic trading systems or trading algorithms, first and foremost, you must ensure that the individuals involved in system design, development, and usage possess the necessary qualifications and capabilities. Conduct adequate testing of the algorithmic trading systems and trading algorithms. Make sure they won't interfere with the market. Take into account extreme market circumstances. And it's essential to operate robustly on a continuous basis. Lastly, test regularly. How many times do you need to check each year at a minimum? At least once a year. To reduce the risk of hacker intrusions, the SFC, Securities and Futures Commissions, guidelines for reducing and mitigating hacking risks associated with Internet trading, has put forward additional requirements for electronic trading systems. So, how should intermediaries protect their clients' Internet trading accounts? What strategies can be used to prevent hackers from invading? Including: the first strategy is two-factor authentication. When a customer logs into their account, a username and password are not enough. An additional identity verification step is required, such as entering an extra mobile phone verification code, which can enhance the security of the account. The second strategy is account notification. If certain activities take place in the account, such as logging into the system, resetting passwords, and executing trades, the related customer should be notified immediately. This can be done via email, SMS, etc., to remind the customer of what's been done on their account. The third strategy is to implement an effective monitoring mechanism and adopt some strong encryption programs. How should intermediaries protect the network infrastructure of electronic trading systems and ensure stable system operation? Intermediaries can set up a demilitarized zone with multi-tiered firewalls, like a line of defense army, to protect the trading system and customer data. In addition, intermediaries can set up authorized access, where only authorized individuals can enter the system and data. Intermediaries should also monitor security patches and repair system vulnerabilities in time to prevent hackers from taking advantage of the situation. Moreover, intermediaries need to protect critical system components and place them in a secure physical environment. Intermediaries should also perform daily offline data backups. Even when facing major system changes, they can be quickly restored. Last but not least, it is very important to have contingency procedures, in other words, a plan B. Our internet transaction system is like a castle. To protect this castle, the person in charge or the supervisor needs to take action. What does this include? Firstly, establish a cybersecurity risk management framework, just like the defense blueprint of a castle, clearly defining key roles and responsibilities. Secondly, formulate cybersecurity policies and procedures. Just like the tactics of guarding a castle, there is a standardized operation that everyone needs to follow. Moreover, review significant issues escalated from cybersecurity incident reporting and perform necessary processing. At the same time, assess the latest cybersecurity threats and attacks, look at the new tactics of the intruders, know yourself and know your enemy, and prepare some countermeasures. Formulate contingency plans, also known as Plan B. Even for some network security incidents, we have backup plans to respond. For employees authorized to access internal networks and systems, provide cybersecurity awareness training at least once a year. Even if we are not at war, we need to train the soldiers so they have the ability to deal with cybersecurity incidents. Timely notify customers of cybersecurity risks, let them know what potential threats might exist. Also, teach them how to protect themselves to prevent these risks. Okay, let's talk about the conduct rules for ALP, alternative liquidity pools. You might be thinking, are ALPs the same as electronic trading? So, I'll ask you, do you still remember what electronic trading is? Speaking of electronic trading, it's about using computers to conduct securities transactions. What kind of transactions? Trading securities on an exchange or futures contracts. Electronic trading is open to everyone, whether you are a large securities firm or just a retired grandmother, everyone can participate. Before trading, users usually see the real-time price of the stock, how many are available, and the trading process is relatively transparent. After talking for so long, what exactly are ALPs? What's the difference? ALPs are electronic systems operated by intermediaries. But what's so alternative about it? It can trade Hong Kong listed securities and overseas listed securities. Can anyone play with these alternative things? Not really. Only some qualified investors, such as institutional professional investors and corporate professional investors, can participate. There is one very, very important thing: it is very mysterious. Before trading, all trading information is not disclosed, that is, prices, quantities, etc. are not visible. It's like a black box operation, with little transparency. So, what does the Code of Conduct stipulate for ALP, alternative liquidity pools? I'll ask you, what needs to be done to have an ALP? Well, you need to design and develop the platform and see how it is applied and operated. Who will manage and supervise it? It's the intermediary themselves. They are responsible for operating the ALP, so they have to take responsibility. Therefore, intermediaries need to formulate and implement written internal policies and procedures, including 1. Appoint responsible officer or executive officer to be in charge of the overall management and supervision of the ALP. 2. Have appropriate measures to manage the risks of the platform. 3. The risk and compliance functions work together to develop procedures. 4. Establish clear reporting lines and assign appropriate staff to supervise and report. Even with these internal policies and procedures, intermediaries need to regularly review them to see if there is anything wrong. If something is wrong, they need to correct it immediately. So when operating an ALP, alternative liquidity pool, what are some alternative regulations for users and transactions? First of all, do you remember who can use this ALP? Can everyone use it? No. Only certain qualified investors can participate. So who are the qualified investors? Institutional professional investors and corporate professional investors can become users of the ALP. Can retail investors participate? No. To play with the ALP, you need to have some alternative status. Qualified investors can issue instructions on the ALP themselves, i.e., customers handle buying and selling themselves, but what if they are busy and don't want to do it themselves? Well, intermediaries can handle transactions on behalf of clients. However, it should be noted that intermediaries can only send the trading instructions of qualified investors to the ALP. If a sexy, beautiful retail investor asks you out for dinner and asks you to place an order on the ALP, can you do it? You can have dinner, but if she doesn't have the status, you can't place an order for her. So when are transactions on the ALP conducted? Intermediaries can conduct transactions on the platform whenever they deem appropriate. In other words, the operating hours of the ALP are very flexible and are not limited to fixed times. How should trading instructions be handled? Non-proprietary trading instructions and proprietary trading instructions for transactions at the same price, regardless of who issued the order first. Non-proprietary trading instructions should be prioritized. Simply put, when there is a conflict between a user's order and the intermediary's own order, the user's order should be prioritized. The ALP is quite complicated. How can users understand the operation of the platform? The operator needs to prepare and regularly update the ALP guidelines to ensure that users understand the operation of the platform. So do users' transactions have to be conducted on the ALP? Users don't necessarily have to trade or deal on this platform. Intermediaries should provide users with sufficient flexibility and autonomy to choose the trading method that suits them best. Similar to electronic trading, intermediaries operating ALPs also need to ensure the ALP's integrity, including the controls, reliability, security, and capacity of the ALP, and having a plan B. The characteristics of trading on ALPs, alternative liquidity pools, are low transparency and high privacy protection, so users usually use them for large transactions. But think about it, what would happen if the information here fell into the wrong hands? One way to ensure the security and confidentiality of the platform is for intermediaries to limit employees' access to trading data. It's not that they don't trust their employees, it's just a safety precaution. So how can intermediaries set up some restrictions? The first and foremost thing is to authorize employees. That is, to limit which employees, under what circumstances, and what trading data they can access, and not to allow just anyone to enter. After setting up the authorization, the intermediary must report employee permissions and access to the SFC, Securities and Futures Commission. This includes which employees can access the platform, what information they can access, and the reasons for accessing, all of which must be clearly explained to the SFC. The intermediary also needs to keep records. The last thing is to ensure persons responsible for originating proprietary orders in the ALP do not have access to any trading and transaction information in the ALP. Why is that? Because if they can access trading information, they may unfairly use customer data and cause potential conflicts of interest. What are the responsibilities of intermediaries operating, ALPs, alternative liquidity pools? First, the responsibility of record keeping. Intermediaries are required to keep proper records of all aspects of how the platform is designed, developed, deployed, and operated. Everything is written in black and white, so there is a basis for everything. Second, the responsibility of reporting and notification. Intermediaries are required to report executed transaction information to users and regulators, providing them with access at any time. If there are any changes in the operation of the alternative trading platform, or if there are any breaches in the operation, the intermediary must notify the SFC, Securities and Futures Commission, so there is no need to worry. Next, let's talk about the Personal Data Privacy Ordinance. What is the last word of it? Ordinance. Does it have a legal effect? Yes. If violated, is there a chance of going to jail? Yes. So what is personal data? Personal data is any data that directly or indirectly relates to a living individual, and this data can be used to directly or indirectly confirm the identity of the person. I simply say, male, 29 years old, 1.75 meters. In this case, is it considered using personal data? No, it's not. Because any male of this age and height could potentially match, it cannot confirm the person. But if I add this person's phone number, plus his email, and combine this information together, that would be some very effective personal data, right? There is a chance to locate this person. How can we use personal data without breaking the law? Remember, this is not about teaching you how to break the law, but how to avoid breaking it. The answer is to comply with the 6 principles of the Personal Data Privacy Ordinance. Basically, remember these things. First, when collecting personal data, there must be a lawful purpose. The data collected should not exceed a reasonable scope. For example, if you only need a name, phone number, and email. Don't ask people about their job, income, where they live, how many people are in their family, whether they have a boyfriend or girlfriend, how much property they have, etc., just because they are good looking. When collecting data, you also need to tell the person why you are collecting this data. Remember, be careful when collecting data, don't be too greedy. Being a greedy dog can easily lose everything. Second, ensure that the collected data is accurate and up-to-date, and the data should not be kept longer than necessary for the use. For example, a company collects personal data to prepare transaction data for customers. Then you have to tell the customer, according to the regulations of the SFC, Securities and Futures Commission, transaction data must be kept for 5 years, so it can only be kept for 5 years, not more than 5 years. Third, if the data subject does not agree, personal data cannot be used for other purposes. For example, if you collect personal data for the purpose of customers using your platform for transactions, you cannot use this data for marketing promotion without the customer's consent. For example, telling people that Jackie Chan has made transactions here, how good and positive this platform is not right. You also cannot provide personal data to others for random use. If you leave the personal data of customers casually on the office desk, everyone can take a look at it. That's not right. You must protect the collected personal data and prevent these data from being accessed, processed, erased, and lost without consent. Fifth, data users, who are also intermediaries, must disclose their policies and practices in personal data, the types of personal data they hold, and the purposes of use. That means, if you collect customers' personal data, you must clearly tell your staff about your policies and regulations for managing personal data to ensure they can comply and not mess around. The sixth is to check personal data. The data subject, that is, the customer, has the right to ask the intermediary who uses his personal data to tell him whether he holds his personal data and can request to provide records. However, the intermediary can charge the customer a reasonable fee for photocopying these documents. So, if the data held by the intermediary is inaccurate, can the customer request a correction? Of course. Not only that, if the intermediary refuses, the customer can also report to the Office of the Privacy Commissioner for personal data. Is senior management important? Of course, it's important. Why is it important? Because all established policies, appointments of different commissioners, and established reporting mechanisms are centered around this senior management. Communication with external organizations is usually the responsibility of the senior management. Within the company, the senior management is the final complaint channel, so the importance of the senior management is obvious. To ensure that intermediaries comply with laws and regulations in their overall operations, whether in dealings with customers or in internal operations and monitoring, i.e., compliance. You can take a look at this page to get a rough idea of the responsibilities of senior management. We have actually talked about these things before, so we won't go into them one by one here. Let's focus on the last responsibility requirement of senior management, good corporate governance. First of all, what is corporate governance? Corporate governance refers to leading and supervising a company through systems and procedures to achieve the company's business objectives. The core is the proper relationship between several types of people within the company. Who are these people? The management of the company, the directors and board of directors of the company, the shareholders of the company, and stakeholders, that is, creditors. Good corporate governance means you must ensure that everyone's interests are not harmed, especially to guarantee that the interests of shareholders and creditors are not harmed. The better the corporate governance, the stronger the competitiveness of the company. Therefore, in Hong Kong, the SFC, Securities and Futures Commission, and the SEC, the Stock Exchange of Hong Kong Limited, are paying more and more attention to corporate governance, hoping that companies can manage more fairly and transparently, and have clearer responsibilities and accountability mechanisms. What are the implications if corporate governance is insufficient? If corporate governance is insufficient, it is very likely to result in abuse of power, engaging in unnecessary benefits, creating serious conflicts of interest, directors and managers engaging in fraudulent, misfeasance, and misconduct behaviors, engaging in improper connected transactions, such as transferring company assets to related parties at a low price, or allowing the company to purchase assets from related parties at an excessively high price, engaging in market misconduct, such as insider dealing. In simpler terms, senior management may put their personal interests above the legitimate rights and interests of the company, use their privileges to seek personal benefits, leading to losses for shareholders or creditors. So, how do we establish good corporate governance? First, there must be appropriate checks and balances. That is, for any administrative body, we must find someone to monitor and regulate it, to limit its power. For example, if the power of the director is too great, what should we do? A. Appoint some non-executive directors and the board of directors. Appoint people who are not involved in the daily operations of the company to balance it. Let's see if that person wants to vote against it. If they want to, they can vote against it. B. In addition, an independent audit committee must be set up to audit. It must be an independent function. C. Third, what must be set up? A remuneration committee. What does the remuneration committee manage? It manages the remuneration of directors and senior management, and the majority of this remuneration committee is made up of independent non-executive directors, that is, directors unrelated to the company decide the director's salary. There is no reason to decide your own salary, right? So, there are some checks and balances. In short, don't manage yourself, find a third party to manage. Good corporate governance should also increase transparency, disclose to shareholders, stakeholders, generally, creditors, and the public. Adopt international accounting and auditing standards. Establish a robust protection framework for small shareholders, creditors, other lenders. Identify corporate wrongdoings and punish the related behaviors. Understanding these things, in simpler terms, is about checks and balances. Let's introduce the Securities and Futures Insurance Rules. What is this rule? It is a subsidiary legislation. Is it illegal to violate it? Yes, it is illegal. Is there a chance of imprisonment? Yes, there is. What does this rule say? It states that all licensed corporations must purchase insurance. However, there are some exceptions. Some licensed corporations do not need to buy insurance. Which corporations are they? Those that do not hold client assets and are not exchange participants do not need to buy insurance. The insurance rules also stipulate that the SFC, Securities and Futures Commission, can approve master policies of insurance. So, what does this insurance cover? It covers the client assets of the licensed institutions. If these assets suffer losses due to fraud or theft, whether the intermediary or others have stolen the client's assets, or the intermediary has misappropriated the client's assets, in short, due to the intermediary's negligence, causing the client to suffer losses, then this insurance will compensate for it, okay? The last one is the CRS, Common Reporting Standard. The CRS is a global standard established by the OECD, Organization for Economic Cooperation and Development, that requires countries to automatically exchange non-resident financial account information in order to prevent cross-border tax evasion. What are the requirements for intermediaries under the Inland Revenue Amendment No. 3, Ordinance 2016? Intermediaries are required to identify account holders during customer due diligence, i.e., to check whether they are tax residents of the reportable tax jurisdictions. If so, they must submit reports to the Inland Revenue Department annually. What is a reportable tax jurisdiction? A reportable jurisdiction is one with which Hong Kong has signed an agreement for the automatic exchange of financial account information, AEOI. As of now, the number of reportable tax jurisdictions has increased from 75 to 126, effective from January 1, 2020. Are you preparing for HKSI, LE, MPFE, IIQE, EAQE, or SQE examinations? Look no further. At 2C Exam, we have everything you need to succeed. Our comprehensive suite of products and services includes premium online and offline question banks, personalized one-on-one tutorial sessions, tailored group classes, and private consultation sessions. Need assistance with licensing or examination inquiries? Don't hesitate to get in touch with our knowledgeable team. We're always here to help. We're open Monday to Friday, from 9 a.m. to 12 p.m. and 1 p.m. to 6 p.m. You can reach us by phone at 211-09644 or send us a message on WhatsApp at 934-72064. Need to send us a fax? Our fax number is 211-19644. Prefer email? Drop us a line at info@2cexam.com. And don't forget to connect with us on WeChat, HK2C Exam. Choose 2C Exam, your path to exam success. Reach out to us today and let us help you achieve your goals.